All right, ladies and gentlemen, thank you for watching our Retiring from ExxonMobil in 2025 webinar. My name is Nick Stenger. We are the Stenger Family Office. For the past 44 years, the Stenger family has made it our mission to help ExxonMobil families retire, get you up to retirement, prepare for retirement, and then navigate post-retirement. And we are a top next gen Forbes advisor team in Illinois here. We run the business as a multi-family office operating structure. So all that means is, yes, we have wealth management, financial planning, all the basics, but we also have in-house tax people. We have CPAs on staff. We have attorneys here in the office that can help with estate planning. We've got everything in one place. Our custodian that we use is Charles Schwab. So Stenger Family Office operates as your independent fiduciary financial advisor on the assets that you have at Schwab. And we just have a minimum starter account of $1,000. We've kept it that way since the 80s so that you can get started ahead of time, get good advice, and not have to have a massive minimum starting amount of assets to get rolling with us. We take that very seriously. We want to help you out wherever you are and then grow together over time. So we're going to jump right into what I would call our ExxonMobil pre-retirement checklist and some of the things that you could be thinking about depending on where you're at. One of the first things is just a very high level. Do I have enough money for retirement? Am I going to have enough to last for a 20 or 30-year retirement or even longer in a lot of cases? Number two, are my investments allocated properly? Am I set up the right way to get through the next couple months, the next couple years, and then even longer term than that? And then there's, of course, some ExxonMobil specific retirement items that will come into play. We'll talk pension today. We're going to talk about healthcare options. We'll talk about a variety of other factors. We're not going to cover everything in today's webinar. So what I would recommend is that you'd reach out to our team, set up a one-on-one meeting with myself or somebody else on our team, and talk about your individual plan specifically. But we are going to talk high level about all these items. And then we are going to wrap up today's webinar with a couple of quick notes here on tax and estate planning, some strategies that we use with our high net worth clients, and what you could be thinking about. So, with that first question, do I have enough money for retirement? The biggest thing we have to answer is, what's your true risk in retirement? Is your risk market volatility, which we'll cover in a second, or is it longevity? Is it the risk of running out of money? And so we're going to cover that. So your risk in retirement, according to at least according to Stenger Family Office, would be longevity risk. And with longevity risk comes inflation. And so it's not okay anymore, like it might have been way back in the day, to just put your money in treasuries and cross your fingers and hope it works out. You have to have some sort of assets in your portfolio that are going to beat inflation over time. The other big issue is, what's my income gap? So if I'm making money now while working at ExxonMobil, how am I going to replace that income when I retire? So the central problem to retirees is income. And how are we going to replace that when you go to retire? So what it comes down to is, off of your portfolio, after we subtract some of the fixed income sources that you're going to have during retirement, what is the withdrawal rate that's appropriate depending on where your age is? And so all of retirement planning is math driven. It's just a simple equation of, what's the right withdrawal rate, what do we think inflation is going to be, and what do we think the portfolio can do in returns. And that's why it's so important. You have to make sure you get that withdrawal rate correct. So the big risk in retirement, like I mentioned, is not volatility. It's not just the market going up or down. It's longevity risk. It's the chance that you'd run out of money during your lifetime because of the rising cost of goods and services. On average, markets correct 10% every 2 years and 5% each and every year. And you're starting to see that now in 2025. We're about 9% in a correction today as we're recording this webinar. Last year in 2024, we didn't have a 10% correction. We got pretty close. We had a 5% and an 8%. But 2023, we had a 10% correction. And so you see that pattern over time, that you have these 5% corrections at least every year, and then the 10% every 2 years. And my point with this is just to say, let's say you retire, like a lot of our Exxon families, at 55 or 58 or 60 or whatever it is. You could be around for a long time, and you could have 15, 16, 17 of these larger 10% pullbacks. That's not risk. That's simply market volatility. If we look at the long-term history of the market, though, this is Dr. Jeremy Siegel, who went back further than anyone. He went back 200 years of market history. And he studied U.S. equities, and he said that they return 10% per year, better than any other asset class the past 200 years. So our true risk is not market volatility. We know that over time, markets are going to climb a wall of worry and produce great results. The bigger problem is, again, if you're retiring between 55 and 60, and you're going to live maybe until you're 85 or 90 or 95, and you think, Nick, there's no way I'm living until I'm 95. Well, there's a chance you could. And we would rather have a little bit extra in the back of the plan than not enough, because you don't want to have to go live with your kids. They don't want you moving in with them, and you don't want to do it either. So we got to make sure that your money is going to last for possibly a 30 to 40-year retirement. This is our big culprit. Long run inflation is not 2% per year. And this is really important to understand. We were coming out of 08 and 09 in an unusual environment where inflation was essentially nothing. We had close to 0% inflation for years. The long-term average, even now, with some of the money printing we did from COVID until today, still puts the inflation rate around 2.5%. Well, if you go back over a longer period of history and you look at inflation in the 70s, the 80s, and some of these more volatile periods of time, long run inflation is not 2 or 2.5%. It's closer to 3.5%. And remember what I said, retirement is really just a math equation. So if you get some of these inputs wrong, you could be drastically off where your long-term plan ends up. For example, if you were starting out in Chicago here and you were trying to go to Hawaii, and let's say the pilot's 1 degree off on their navigational system, well, you're not getting to Hawaii. You may end up in Japan or somewhere that you didn't intend on going. Well, that's the reality with retirement too. You've got to dial these long-term numbers in. So what we want to find out is what's your income gap during retirement, because that's the big problem that we have to address. We need to be able to cover your expenses. You're going to have a little bit increased expense from healthcare as well when you retire from ExxonMobil. So we want to be able to pay for that. And so what we do is we just start taking an inventory of what your income is going to be during retirement. It might be if you take a annuity pension, of course, your Social Security is factored in there. There might be some other rental incomes or something else that you would have. And we're going to say that if you were working at ExxonMobil, that your net income per month coming out from your paycheck, hitting the bank account, let's just say in this example, was about $10,000 a month. A lot of people ask me, Nick, how do I know what my expenses are? There's 2 really good ways to do it without having to sit down and create a full budget. Number one is look at if you have any debt. If you got credit card debt or you got installment loans, that's much more concerning. But most of us, as we get close to retirement, we're probably not going to have too much in credit card debt, or at least we shouldn't. And if we do, we should have a plan to pay it off before retirement. So whatever's hitting your bank account coming from payroll every 2 weeks, that's the number. That's the amount of cash that you're bringing in every month. And if you don't have debt, that's probably what you're spending. The other way to do this is look at your credit cards, and the Chase credit cards do a really good job of summarizing every month and every year what you spent. So that's how we figure out what that $10,000 a month number needs to be. Now, what I like to do is add in a little bit on top of that. You may not need it all, but we'll typically add about $1,000 a month when you retire to cover a married couple for their health care if you stay on the ExxonMobil POS1 or POS2 plans. And then what we're going to do is say that you need $11,000 a month net in income, and we're going to subtract whatever your fixed income is from that. So if your Social Security before taxes is assumed to be about $3,000, we know that we're going to need a net withdrawal, meaning an after-tax withdrawal of about $8,000 per month. We know that your taxes are going to be in the 20% range in this example, maybe 23%, 24% on the higher end. And so again, just real basic, easy example here. We're going to factor in about $2,000 a month for taxes. And we think in this example, this person is going to need a $10,000 a month draw from their portfolio. So again, what we want to find out is how much money do you need to make this plan work? How much do you need to have saved up in investments to be able to take that $10,000 a month? And so in this case, $120,000 a year at a 4% withdrawal rate would mean that we would need $3 million saved up for retirement. What starts to get interesting is when you change that withdrawal rate assumption, and let's say we push it up just 1%, and instead of taking out only 4%, we're going to take out 5%. Well, now you only need $2.4 million. It's just math. And so it's our job, or it's your advisor's job, to help you dial this in. This is just a good rule of thumb, but you really need to have this dialed in on your individual plan. So, what's the right withdrawal rate while you're retired to make your money last for 30, 40 years, or however long you're alive? It's a basic math equation of withdrawal rate plus inflation must equal the rate of return in your portfolio. So, again, withdrawal rate plus inflation has to equal the rate of return. If you're going to take a 4% withdrawal rate from the portfolio in that first example, and we think inflation is going to be 3 to 3.5%, then you have to have a 7.5% net return on your portfolio to be able to keep this plan going over time conservatively. If you go to a 5% withdrawal rate, and then you add in the 3.5% inflation, what does it do to the equation? Well, it means that we have to get a higher rate of return on the back end of the portfolio. This is very important to understand because I see a lot of advisors out there who say, oh, yeah, you could take a 4 or 5% withdrawal. They do a fancy financial plan where they have this 300-page document they print out and give to you, and you have no idea what any of it means. And, some of the pages are like way over everybody's head and are just complete nonsense. Well, all that financial plan should show you, like what we do at Stenger Family Office, is it should show you what's the appropriate withdrawal rate. And then beyond the withdrawal rate, can the investment portfolio that advisor has for you actually accomplish the withdrawal rate plus the inflation? So if you're going to take a 5% withdrawal, then you have to make sure the portfolio you're in, the investments you're allocated to, are actually going to accomplish that. And this is what I want to show you. Here's historical returns on a variety of asset classes that you can be invested in over the past, this goes back now to 1928 and then ends at the end of 2024. So this is a pretty long time frame. U.S. equities, large cap U.S. companies have done 10.1% per year. International stocks, that's Europe, Japan, China, Latin America, have done 5.9% per year. Real estate's gone up 4.2, gold's gone up 5.1, bonds have gone up 4, cash has gone up 3.3. And then looking forward, so this is a variety of Wall Street estimates. This is Stenger Family Office research. We think U.S. equities are going to go up 10%. We think international is going to do about 5.5. We think real estate's going to be about 4. We think gold's about 5. We think bonds are about 4. We think cash is about 3. We expect a lot of the same for the next 10, 15, 20 years. But what happens is when you adjust for inflation and you look at real returns, that's the column on the far right. You back out that 3.5% inflation, and your real return on U.S. equities drops to 6.5. Your real return on international goes to 2. On real estate, it's 0.7. It's barely break even. On gold, it's just barely break even. On bonds, it's barely break even. And remember, on cash only pays typically what the rate of inflation is. Well, cash has a negative return over time because of inflation. So we have to ask this question, are we in the right asset classes? Do we have the right portfolio that can sustain that withdrawal rate over time? Well, here's a traditional 60-40 portfolio. We've been saying for a long time how dangerous the modern portfolio theory or the target date funds can be to a portfolio over time. Look at the underlying holdings of what you would have with a 60-40 portfolio. And maybe your advisor has you allocated 70-30, for example. Typically, they're going to have 35% in U.S. equities, maybe 15% in international, 10% in small and mid caps, and 40% in bonds. If we just do the basic math here, the expected rate of return on a portfolio like this now is 6.9% before fees. And if you're paying your advisor a traditional 1% advisory fee, your net return is 5.9% on the 60-40 portfolio. And again, this is forward looking, so there's no guarantees of what's to come, and we have no idea what the future holds, but this is our expectation. And so if you're only going to be able to get a 5.9% rate of return and inflation's 3.5%, that means you can only take 2.4% as your withdrawal rate. You have to be very, very careful about this over time. You say, Nick, can't I just take my full 5.9% out? We would say, no, that's not being conservative, because over time, that 5.9% of the portfolio is going to diminish because of inflation. So instead of doing this all in a risk-based plan would say, on a scale of 1 to 5, How do you feel about markets? How do you feel about risk? And then somebody, some advisor would put you in a moderate portfolio, for example, which is traditionally this 60-40 mix. We want to do a goals-based financial plan, a goals-based investment plan for you, not risk-based. We don't want to just give you a score from 1 to 5 and put you in a cookie cutter portfolio. We want to customize it according to what? What are my goals? And so that's the next piece of this is we need to figure out what your goals are. Well, number one, for all of us on today's webinar, we would say we don't want to run out of money. We don't want to get to 90 years old and not have enough to finish out the rest of our lives. Number two, it might be rising healthcare expenses. Healthcare compounds not at 3.5% per year, but now 5.5% to 6%. If you're going to help out with grandkids' college, for example, or maybe your kids are saving for college for their kids, well, they might be saving for college with an assumption of 6% for college expense inflation. So these are the things that we would start to figure out. Through a series of questions, we would find out maybe there's some other bucket list items that you'd have. There's some other things that you'd want to do, and we'd put this into the plan. Now, let's go back to the original assumption, in this case, that somebody would need $10,000 a month from the portfolio as a withdrawal, meaning $120,000 a year. Well, in the traditional 60-40 mix, or you fill out that risk score and you get scored out as a moderate, they would go conservative. And they would say about 6 years of reserves of the portfolio would be in something very, very short term or safe. Well, you have to understand what safe means. You have to understand what the safe piece of your portfolio is. At Stenger Family Office, we believe that that means short duration U.S. Treasuries, essentially cash and cash equivalents, not bonds. Because when you went through the past 4 or 5 years with COVID and you saw inflation go way up, we went from 0% interest rates to 5.5% and not all that long of a time frame. Bond prices got crushed. And so people literally lost 30-40% on some of their longer term bonds. We said you have to be so careful about that. We want to keep that safe money safe. We want to keep your growth money growth oriented. So if you're ultra conservative and you wanted to have 5 to 6 years on the higher side of the portfolio as safe money, you could go 700,000. I think for most of our clients, we would recommend this middle bucket that we could now define as moderate, saying 120,000 times 4 years of reserves puts you at $480,000 of the portfolio where you don't have to worry when times get tough. If you wanted to go more aggressive, meaning you had some additional fixed income coming in, you have plenty of RSUs that are going to be rolling out when you retire, and you don't need as much safe money built into the plan, you could go 2 years. That puts you at 240,000. So that's the correct definition, in our opinion, of defining risk, defining the plan, is that you have to do this on a goals-based plan. We have to know what you're specifically going to need, and then we want to multiply that by anywhere from 2 to 4, maybe 5 times of that number, and keep it safe, truly safe, so that when times get tough, your safe money isn't exposed to risk. So here's an example of what we would consider a middle-of-the-road moderate portfolio. We would have U.S. Treasuries sitting at $480,000. That's 4 years of living expenses. Right now, earning about a 4% return. We have our U.S. large cap equities, $1.5 million, returning about 10% per year. And what we would assume is that going forward, our gross return before fees is about 8.8% per year. And then after that 1% fee, we'd be about 7.8% per year. So when we do the math backwards and we assume a 7.8% investment return with 3.5% inflation, that puts us right at 4.3% on our withdrawal rate. And I think for most people, that's a conservative place to be over time. So that's the difference between risk-based and goals-based planning. So a couple of things here, ExxonMobil specific, the timing of retirement, interest rates. Obviously, during times like COVID where rates are zero, that's a great time to take that lump sum pension if you can, because when rates go down, the pension value goes up and vice versa. Right now, I think rates are probably going to trend lower. They're not going to go immediately lower. But over the next 2 years or so, I think you're going to see increased value on the pension as rates start to moderate. And I think we're going to see a trading range on the U.S. 10-year, which is what these pensions are really based on. And we're going to be anywhere from 3.5% to 4.5% yields. That's not a bad environment to be in. You may have originally wanted to retire at 55. We may advise you, hey, if you can wait, let's try and get you to 57 or 58, for example, and pick up a little bit more accrual on the pension. So that's one of the things that you'll have to think about. Lump sum versus the annuity. In most cases, we're going to recommend the lump sum. There's better returns, I think, long run after the 9 or 10 year mark. There's no guarantees of this, of course, but I think if you take a lump sum around that 9 or 10 year mark, you are going to do better. And then number two, with that decision is the fact that you cannot pass the annuity past your spouse. And so if estate planning is important to you, if a longevity plan is important to you, you want to have the lump sum to be able to pass to the next gen. And we talked a little bit about when to take the lump sum. I would take it immediately at retirement, unless you're right next to your next birthday. If you're 55 in 10 months or something, you could wait till 56. But the thing that works against people sometimes is they defer the pension way too long. They try to get that 4 or 5% guaranteed increase. And the markets, again, over 200 years go up 10%. So I've seen this happen to people where they retire at 55, they defer the pension until 60, and they missed out on 100% or 60% return on the stock market just to get a 25 or 30% increase on the pension. So again, don't just use single factor analysis on the pension. You need to use multi-factor analysis and look at all these different things that go into the decision. RSUs come into the tax equation, and we'll talk about that in a second. But RSUs continue to get paid out to you in most cases after you retire on their vesting schedule. So depending on if you have a lot of RSUs and when they're going to vest out to you, we would go tweak the investment plan and could possibly become a little bit more aggressive on the investment plan if you're going to have these income streams at retirement. If you're at a certain level at ExxonMobil, like many of our clients are, you may even have a supplemental pension that gets paid out to you as taxable income. And so that's another factor that pushes you closer to the 59.5 zone if you're not already, which reduces the amount of withdrawals we're going to have to take for the portfolio. And so there's a variety of factors here that we would consider. RSUs go into that. NUA, net unrealized appreciation, is essentially a strategy where you would hold some of your low basis ExxonMobil stock, and instead of cashing it all out or rebalancing it away, you would hope that Exxon at least stays where it's at today from a price standpoint or goes up a little bit. And then at retirement, when you have a qualifying event, typically there's a few. One would be retirement. One would be at 59.5. You can utilize NUA and essentially have your cost basis of the stock paid out to you as ordinary income, but the gain, meaning the difference between today's price and the price that was paid for the stock, paid out as a capital gain, subject to lower taxes. Now, some advisors make this a big deal and make this a really complicated strategy. In a lot of cases, it is a good deal, but I think sometimes there's a little bit of fluff that goes on with NUA, trying to make it seem like it's this amazing thing. In a lot of cases, it's a very small tax difference. So instead of focusing on NUA from a tax perspective first, we want you to focus on it from an investment standpoint first, meaning, do you really want to hold this much X amount in ExxonMobil stock? That's the real question. So start from the investment decision first, and then we can back into the tax discussion. And then the other thing that we talked about a little bit is retiree healthcare. That's one of the things you're going to have to think about. If you want these slides sent to you, just send over a note, nick.stenger@stengerfamilyoffice.com. Give us a call, 630-912-8295. We can help you with a lot of these decisions and send you these slides so you have these checklists in front of you. But you'll have to make a decision on retiree healthcare. I will tell you, our clients who have been retired with us since the 80s with Mobil have been very happy with the ExxonMobil retiree health system. So it's a very good option. I think most people will do just fine on it. And then group life insurance tends to get very expensive when you retire. The biggest thing is, are you going to have to pay some debt off when you go to retire? Are you going to have debt hanging over your head for a few years after retirement? In some cases, we can shop out your term insurance to the street and see what we come back with. A lot of times that is cheaper than group life, because if you try to take that group life with you, the rates start to really go up as time goes on, and they can even go up every year depending on your age. Let's briefly talk about tax and estate planning strategy, and we'll wrap up today's webinar. Number one of the big things that's coming for all of us is required minimum withdrawals, RMDs, required minimum distributions. And this, for most people, is going to start at age 75. Some people are in the 73 zone, but for a lot of people in the 55, 60 zone, you're going to fall into the new rules that push the RMD age out to 75. And what's really important to understand is that the RMD is only going to be on your pre-tax IRA balances. So most of your pension is going to be subject to this. Most of your 401k is going to be subject to this. Any other pre-tax IRAs you have, but not your brokerage accounts, not your Roth IRAs. In fact, Roth IRAs are never taxable to you or to your kids. Your kids will have to take distributions from them eventually when you pass, but those distributions aren't taxable. The problem with these pre-tax IRA distributions, these RMDs that start coming in, is the fact that if you don't withdraw all the balance from your IRA, which is tough to do with the market going up and even taking some money out of the IRAs, it's going to be tough to get these distributions all done during your lifetime. When a non-spouse, usually your kids, for example, who inherit these pre-tax IRAs from you, under new rules that started in 2020 and 2021, are going to have to liquidate the IRA balance within 10 years. They used to get a stretch distribution. They might have had 16, 18, 20 years to take the money out. Well, now it's all done in 10 years. And so that really changes the math of taxes when you go to pass this down to the kids. So one of the things that we like to say is we like to have people try and spend IRA money if they can, and then move on to the taxable balances and try and preserve most of that for the kids. You'd want to preserve your Roth IRAs and your taxable accounts for the next gen, because again, in the case of a Roth IRA, they're not going to have any tax owed on it. And with a taxable account, like a brokerage account where we bought Apple stock, for example, at $100 a share, maybe now Apple's appreciated to $300 a share. If they inherit the Apple stock from mom and dad, they're going to get a stepped up cost basis. And IRS, under current tax law, says that their new basis on Apple stock is not 100, it's 300, and they can sell it with minimal tax implications. So that's one of the things that we like to do in the tax planning. We want to maybe even do some Roth conversions before you get to age 75. That should be done on a plan. Estate taxation, most people are not going to have an estate tax issue under current tax law. The current tax law has a married couple able to pass down $30 million to the next gen without any estate tax. There are some state-specific issues, like Illinois kicks in at $8 million for a married couple. But for most people, if you're living in Texas, if you're in some of these other states outside of Illinois, you're not going to have a federal estate tax issue under current law. That could change, though, and eventually, if they change current tax law back to where it used to be, that number drops from 30 million to around 15 million for a married couple. Well, you may not think you're at 15 anytime soon, but if you compound money over 20, 30 years, maybe even 35 years, you could get there. And so that's one of the things that we want to help people plan for. And then we also want to make sure that at a minimum, you have a comprehensive estate plan, that you would at least have a will. But I would recommend most people would have a trust, a comprehensive trust put together, not just to avoid probate, although that is one of the features of a trust, but also to help designate where the money is going to go when you pass according to your wishes. And there's a variety of things that trusts provide, a variety of benefits that trusts have for the next gen. It protects them in a lot of cases from lawsuits. It protects them in a lot of cases from failed marriages. And so what we found with comprehensive estate planning, if done the right way with a team, with a comprehensive multifamily approach like we have, is you can typically pass the money down for many generations. So Stenger Family Office today, we're now on our fourth generation of families still working with us that started in the 80s. And that's what it's all about for us. We want to help you pass down multi-generational wealth and help you structure this plan according to your wishes. Maybe that's not your goal to pass down millions, but it could happen. The reality is a lot of people will pass down more than they think. And so at a minimum, we also want to just help you not leave a mess behind. And my opinion, it's a little biased, but my opinion is the best way to do that is with the family office structure. So if you're thinking about taking the next step, this is what it would look like. You would open up a starter account with us, with Charles Schwab. We do it for you. We get you all set up, and you can fund it again with a minimum of $1,000. Then we link your 401k up electronically. We don't charge you to help you manage your 401k. We just give you some basic advice throughout the years, some rebalancing, and that's all included in our starter account program. So number two is the 401k rebalancing at Voya. Number three, then, is we give you a customized and comprehensive financial plan with our team, and then we get you ready for retirement whenever that might be. Here's our contact information. We have offices in 3 states. We are in Spring, Texas, right across from headquarters there. If you know where Common Bond is, we're on the 4th floor of that building, right across campus from you. We're in Baton Rouge. And then, of course, Naperville is our home base, where we started years ago helping out folks from the Joliet Mobil Refinery. And it's just been a joy to work with many of you, and we hope that we can work with many more of you very soon. So reach out to us if you want to do a one-on-one consultation. If this is appealing to you, the multifamily office structure, I think that this is a very good structure if you want to at least not leave a mess, but number two, help structure multi-generational family wealth as well. Our direct number is 630-912-8295. Reach out to us. We're happy to talk. Take care.